Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 19th of June. I'm Daniel Lam, your host for the podcast. There was a slightly hawkish tilt at the FOMC overnight. Overall, the key message is that the FOMC is extremely unlikely to make any monetary policy shift until September. But the Fed is staying prudent. Despite the set of softer than expected CPI figures, uncertainties remain. Powell emphasized that the economy and labor markets were solid, but tariffs would boost inflation. And of course, we know that continued conflict in the Middle East would add risk to disruption in oil supply, leading to higher oil prices and feeding through to US inflation. Now, the updated dot plot showed upward revisions to both inflation and unemployment projections, as well as to policy rate expectations. Now, the 225 median Fed funds rate dot remained unchanged, signaling 50 basis points of cuts. But only one FOMC member would need to shift that dot for the median to move to just 25 bips of easing. Reflecting elevated uncertainties, the Fed projections revealed two camps within the FOMC. Now, 7 participants now expect no cuts this year, while 8 expect 50 basis points of easing. Now, the more hawkish group is focused on the risk that tariffs would lead to a sustained rise in inflation in the coming months. The dovish group aligns more closely with Governor Waller's view that tariff-related inflation will prove transitory. So, market reaction. S&P 500 came off and gave up the intraday gains after the FOMC announcement, ending a day flat, while the US 10-year yield was also relatively unchanged. At this stage, the market is more focused upon further developments in the Middle East. Should there be a quick de-escalation in the tensions there, one would expect S&P 500 to test the resistance level at 6,149. And we see that going to slightly above that to 6,200. Positioning in US equities has been normalizing, but still below historical levels. Overall, global equities should be quite well supported, barring any significant rise in tensions in the Middle East. Now for bonds, the enactment of government bond buyback is keeping a lid on the yields. We see strong resistance for the US 10-year Treasury yield at 4.5% and see the yields coming down to the 4% to 4.25% area over the next 6 to 12 months. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.